It's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle it. That hurricane is right out there down the road coming our way. You better brace yourself. Jamie Dimon is one of the biggest names in the world of finance, being the chairman and CEO of JPMorgan, the fifth largest bank in the world. Dimon is not someone to hold back on what he thinks about the economy, and recently he released his letter to shareholders where he details his thoughts on the economy, the recent banking crisis, and what it all means for the future of the economy. He also did a quick interview with CNN to discuss these topics. If you look at history since World War II, we've not kind of faced it like that. It's still early in that will go on for longer. We don't really know the outcome of QT. I will be right about QE and QT for 50 quantitative tightening. Okay. In 2022, Dimon warned us about an economic hurricane looming over us. Especially as he explains in his letter, 2022 was an unusual year economically, and we witnessed several dramatic events. We saw the start of the Ukraine war that continued throughout the year, which added pressure to the already growing inflation that happened as a result of the COVID stimulus spending. Both of these influences led inflation to a 40-year high, reaching over 9% in June of 2022. This led to an accelerated increase of interest rates from the Federal Reserve that began in March and increased the federal funds rate from 0.1% to 4% by the end of the year in an attempt to control inflation. Inflation remains too high and the labor market continues to be very tight, and we remain strongly committed to bringing inflation back down to our 2% goal. This stalled economic expansion and led to a decrease in market values, collapsing the entire stock market by around 20%. But at the same time, unemployment fell to a 50-year low as supply chain issues eased and the economy was being stimulated. Long and short-term interest rates presented a sharply inverted yield curve, which is 848 in terms of predicting a recession. But despite all of this, Dimon says that the economy seems to be running quite well. Unemployment stayed low, wages are starting to go up, and spending increased significantly, up 23% from pre-COVID years. Finally, supply chains are recovering, businesses are pretty healthy, and credit losses are extremely low. Although the economy has performed much better than expected, Dimon warns that there are still storm clouds ahead. Has this banking crisis increased chances of a recession here? Yes, it's just like another weight on the scale. Okay, and the figure is, people say it's like raising rates of 50 basis points or something like that. We are seeing people reduce lending a little bit, cut back a little bit, pull back a little bit. It won't necessarily force a recession, but it is recessionary. Until the collapse of Silicon Valley Bank, the current economy was performing adequately. The market was generally forecasting either a soft landing or a mild recession. But the failures of SVB and Credit Suisse have significantly changed the market's expectations. Bond prices have recovered dramatically, the stock market is down, and the market's odds for a recession have increased. But Dimon makes a point that this banking crisis is more of a crisis of trust than it is logistically. The main fear is having another financial crisis like we did in 2008. But as Dimon said, this is nothing like the 2008 financial crisis. This is not 2008. Okay, this is much more limited. There are only a handful of banks that have this particular problem. They'll eventually be resolved one way or another, and I think then people should take a deep breath. In a week or two, a lot of these banks will be reporting earnings. I think they'll probably be pretty good. The Federal Reserve made some, bold, dramatic moves to help it easier for some of the issues they had, and I'm hoping it will resolve, rather shortly. Jimmy's point is that there are a few banks that seem to be the exception to the rule and dramatically mismanaged their risk allocation, which got them in trouble. What happened with SVB was a mismanagement of their risk allocation. They held a large amount of government bonds that went down in value as interest rates rose, making them lose some of their depositors' money. The second factor was that they had a very concentrated and specific client base who held a large amount of money. There were clients like startups and tech companies. And as the economy slowed down and these small number of clients starting withdrawing their money at the same time, they got in trouble. But as Dimon says, most of their risks were hiding in plain sight. Yeah, so I said there's hide in plain sight. Everyone knew about uninsured deposits. Everyone knew about interest rate exposure. Everyone knew about held-to-maturity portfolios. The only real difference was we called concentrated clients. So Silicon Valley Bank had, a handful of people controlled 35,000 corporate accounts. And they just left, $140 billion or something over a course of 2 days. That's not happening to other regional banks. Well, they don't have that issue. Nor do they have always other issues. So it's only a handful that have much upsides. Interest rate exposure, the fair value of held-to-maturity portfolios, and the amount of SVV's uninsured deposits were always known, both to regulators and the marketplace. The only unknown risk was that SBV's over 35,000 corporate clients were controlled by a small number of venture capital companies that moved their deposits almost simultaneously. And when all of those clients tried to withdraw their deposits and the bank didn't have their money, the bank collapsed. But Dimon makes the point that the rest of the banking system does not operate this way. The most critical banks have a large and diverse client base. They have hedged their portfolios better and they're well capitalized. And they have the backing of the Federal Reserve. In other words, the mismanaging of a small number of regional banks does not represent the entire banking system. But what does this mean for the future of banking? Dimon emphasizes that this banking crisis is nothing like what occurred during the 2008 global financial crisis, which barely affected regional banks. Remember, in 2008, it was hundreds of institutions around the world. Far too much leverage, we don't have that. Huge problems in mortgage markets, we don't have that. This is nothing like that, and the American public shouldn't think that. This will resolve, and then we should go look at, what went wrong and fix it. In the light of day. In 2008, the trigger was a growing recognition that $1 trillion of consumer mortgages were about to go bad, and they were owned by various types of entities around the world. At the same time, there was enormous leverage virtually everywhere in the financial system. Major investment banks, Fannie Mae, Freddie Mac, and nearly all savings and loan institutions collapsed. But this banking crisis is mostly contained to small, poorly managed institutions, which is good news for the banking system. But what about the future of the economy? Dimon still has a few concerns for our economic future. Storm clouds ahead, you say, maybe some, for the economy. Yeah, I might mention the QT, higher inflation for longer, the war. Those are pretty strong things. If you look at history since World War II, we've not kind of faced it like that. It's still early in that will go on for longer. We don't really know the outcome of QT. I think we'll be writing about QE and QT for 50 quantitative tightening. Quantitative, just a fun video. Okay. These storm clouds that Dimon sees in the future are the tightening of monetary policy, high government spending, and the unpredictable consequences of the Ukraine war. QT, or quantitative tightening, is the implementation of stricter monetary policies that reduce the Federal Reserve's balance sheet. In other words, they sell treasury bonds or let them mature to take money out of the economy in an attempt to cool down demand and control inflation. This action reduces the amount of cash in the financial markets, which puts negative pressure on the stock market, limiting its growth. The problem is that high government spending can be inflationary, so to counteract this inflation, the government might choose to have tighter monetary policies that will put even more downward pressure on the economy. The deficit for the next 3 years is now estimated to be anywhere from $1.4 trillion to $1.8 trillion per year, which means the government will be spending around $1.5 trillion more than they bring in every year. And this is not taking into account the cost of a recession or a war. The Ukraine war is also affecting global energy and food supplies. There is a risk that energy and food supply lines, which are not secured, will lead to higher prices and a large migration of people, triggering another level of geopolitical dislocation. The tensions of this war are also leading to the rethinking of many economic alliances, as well as trade and national security. All of these factors create more risk and potentially higher inflation, which again leads to tighter monetary policy, which puts negative pressure on the economy. Although we have some storm clouds ahead, Dimon still believes that the U.S. is a strong economic force and will do just fine in the long term. We're going to have, whatever we go through the next couple of years, America in almost every 10-year period, going back all through our history, is much better at 10 years later than it was before. That includes 1940 to 1950. That includes 1930 to 1940. And so the health of America is the strength of its peoples. Human capital is brain power, is capability, is capital markets. We're the widest, deepest, most transparent capital markets the world's ever seen. And that includes venture capital, private equity, media. We've got open media, freedom of speech, freedom of religion, freedom of enterprise. But the most important that is freedom of people to do what they want. Like if you're starting a beauty, so there's two wonderful ladies starting business here. Yeah, it's that. That's at the heart of America, and that's still there. That has not gone away, and we should applaud it. I mean, we should sing here. I wrote in my letter about all the stuff we do to help society and communities and philanthropy and DI. I said, but lest my Charlotte forget, I'm a red-blooded, full-throated, free market, free enterprise capitalist. Faye, we should applaud free enterprise. We should sing from the hills the benefits while we fix the negatives, as opposed to denigrate the whole thing. And there you have it. These are Jamie Dimon's thoughts on the current state of the economy and what is to come. Do you agree with Dimon, or do you have different thoughts? Let me know in the comments below. And if you want to see Ray Dalio's thoughts on the current US economy and where we are in the economic cycle, click on this video right here.